Welcome back to Investor Return. If you're new here, we help people turn confusing finance into practical steps, calmly, no judgment. Today, if I had to start investing from scratch today, with everything I know now, what would I actually do? That's the frame for this episode. JJ, want to jump in with why this matters right now?
Yeah, absolutely, Heidi. So, the headline is simple. Investing is more accessible than ever. Apps, fractional shares, zero commission trades, but lots of people are still fragile financially. For example, a recent Fed report showed 37% of adults would struggle to cover a $400 emergency expense. That means a single unexpected bill can wipe out someone's financial plan.
Right. And I say this as someone who started investing 8 years ago after crawling out of credit card debt and a $400 emergency fund. So when I say you're not late, I mean it. I've been there. The goal today is to give listeners a 7-step roadmap so you can build confidence, avoid rookie traps, and set up real systems, not chase hot tips. Sound good, JJ?
Totally. And quick reminder, none of this is personal financial advice, just education and a practical roadmap. Okay, step 1?
Step 1, get your financial house in order. Don't invest from a place of fragility. This is basic, but so often skipped. If you invest before you fix the holes, you risk being forced to sell in the worst moment. Imagine a hot water bottle with a hole. The water is your money, the bottle is your accounts, and the hole is high interest debt. The hole wins every time if you don't patch it.
Exactly. And to make that concrete, many credit cards charge 20-30% APR. The long-run stock market might average 8 to 10% a year. Paying down a 24% card is like a guaranteed, before tax, 24% return with zero market risk. For most people, high-interest consumer debt first, investing second is the right sequence, period.
Yeah. And after high-interest debt, build an emergency fund, the emotional shock absorber. We're aiming for roughly 3 to 6 months of essentials: rent or mortgage, utilities, food, insurance, transport, minimum debt payments. It's okay if that takes 12 to 24 months. Call it level 1 wealth. When you have that buffer, you don't panic sell during a market drop.
Short turn. What about income and tracking? People often skip that part.
Good point. Know your net monthly income and actual spending. Track for 2 to 3 months. The gap is what you can safely direct to debt, the emergency fund, and then investments. Simple frameworks like 50-30-20 can help as a starting point, but more powerful is pay yourself first. Automate contributions right after payday. Reverse budgeting works too. Decide your savings target first, then let lifestyle fill in.
So step 1 and 1 line. Patch the hole, build the buffer, know your inflows and outflows. Then you can invest from strength. Next up, goals and time horizon.
Yes, step 2, your money needs a job description. Without goals, folks buy random funds or stocks and then panic when volatility hits. In one survey, a financial regulator found fewer than a third of investors had specific long-term goals. That's why setting 1 to 3 clear goals and a time horizon matters.
Let's break the horizons into 3 buckets. Short term, 0 to 5 years. Think house down payment or a wedding. Keep that cash-like. Stocks can drop 30-50% in a bad year, catastrophic if your deadline is 18 months away. Use high-yield savings, CDs, or short-term bonds with caution. Medium term, 5 to 10 years, maybe a big home upgrade or a career pivot. A mix of conservative stock exposure plus bonds could make sense. Long term, 10 plus years, retirement, financial independence. Historically, stocks have been far superior over decades.
Right. To give an example, long-run S&P 500 averages are often cited around 8 to 10% per year, depending on the period and method. That historically favors equities for longer time horizons. But the practical rule is simple. Short-term certainty, long-term growth. Cash for the next 5 years, stocks for decades after that. And translate goals into numbers. Pick a flagship goal, like retiring with X dollars a year. Work backward using a conservative growth assumption, 6 to 7% real, for example, to estimate monthly contributions.
I like that. And don't stress about precision. A ballpark beats no target. Knowing you're investing for 2046 you versus a car in 18 months vastly changes your behavior when the market falls. Okay, step 3, the right investment accounts.
Yes, use the right containers before you obsess over the ingredients. If you're in the US, the workplace retirement plan, 401k or 403b, is often step 1 because of employer match. If your employer matches, say, up to 6% with a 50% match, that's free money, an instant risk-free return on that portion. Capture the match before you open a taxable brokerage account.
And then IRAs, traditional versus Roth. Traditional may give you a tax deduction now. Roth uses after-tax money and offers tax-free growth and withdrawals later. For many young people, Roths make sense because your current tax rate is likely lower than what you'll face later. Also check contribution limits for the current year.
If you're not in the US, there are analogs. UK workplace pensions and ISAs, Canada's TFSA. These tax-advantaged wrappers matter. And don't forget the HSA for those eligible in the US. Triple tax advantage. Tax-deductible contributions, tax-free growth, tax-free withdrawals for qualified medical expenses. Some people even use it as a stealth retirement account if they can afford to pay medical costs out of pocket today.
Then finally, taxable brokerage accounts for flexibility once you've captured match and used retirement and ISA-like accounts. No penalties on withdrawals, but taxable events apply. The 80-20 rule. Get the match, use retirement accounts, then move to taxable if you still have money to invest.
Short break? Are we still with me? Okay. Step 4. Start small, be consistent. Size matters less than consistency and time. The classic example, $100 a month for 30 years. At 8%, you end up roughly $135K, $140K. At 10%, closer to $200K. Your contributions would be $36,000. That means the rest is compounding. You put in a compact car, compounding hands you a house. That's the magic.
Yeah, compound interest explains simply, your returns earn returns. Year 1, $100 grows to $108 at 8%. Year 2, that $108 earns 8%. Fast forward a few decades and the returns dominate. Also, the first small amounts aren't about the dollars. They're about learning the mechanics, placing a trade, understanding a fund, reading statements. Those skills scale.
And to beat the fear of I don't know enough, many people overestimate the risk of investing and underestimate the risk of not investing. Behavioral studies show investors often buy high and sell low. Dollar cost averaging helps. Invest a fixed amount regularly, and you buy more when prices are low and less when prices are high. It removes timing the market from the equation.
Step 5. Diversification. Build a balanced investment plate. Don't put your future in one stock, one sector, or one fad. Index funds are the beginner's power tool. They track a market index, S&P 500, total U.S. market, or global indexes, giving you built-in diversification across sectors and thousands of companies. And they're cheap. Expense ratios on broad index funds often run 0.03, 0.10%.
Low fees matter. Every percentage point saved on fees over decades can mean tens of thousands of dollars more in your pocket. Also, studies like Spiva show many active managers underperform after fees. For beginners, a one-fund global index or a simple stock-bond split, say 80-20, works. Or a single global stock index if you want extreme simplicity.
If someone insists on picking stocks, keep it small, 5 to 10% of your portfolio as fund money. Concentration amplifies both upside and downside, and a big loss can break your psychology and make you quit investing. The safer path is diversified index funds as the core.
Step 6. Automate and simplify. The less you rely on willpower, the better investor you become. There's a widely circulated story that some of the best performing customers were inactive or even dead. The point is, overtrading hurts returns. Set up an auto transfer from checking to your investment account on payday, set recurring investments into chosen funds, and consider auto escalation. Bump contributions 1 to 2 percentage points yearly.
Practical setup example. On the 2nd of each month, $300 to an S&P 500 index fund, $100 to a bond index fund. Automation gives you consistency, shields emotions, and builds wealth invisibly. Keep the number of funds small and do an annual check-in rather than daily tinkering.
Boring works. Seriously, simplicity is an edge. Your advantage isn't predicting the next hot theme, it's showing up every month for 20, 30 years. Okay, final core step. Step 7. Stay calm when the market drops.
Crashes are not a bug, they're a feature. Over roughly 150 years, markets have seen dozens of major drops and about 20 bear markets of 20% plus. Examples we all remember: the dot-com bust, the global financial crisis, and the COVID crash. Each felt like this time is different, but long-term charts show dips on a generally rising trend.
Recovery times vary. The COVID crash recovered incredibly fast, months, while the dot-com fallout and 2008 took longer. If your horizon is 20, 30 years, a 1 to 3 year downturn is painful but not fatal, provided you don't sell everything and you had your emergency fund so you're not forced to liquidate.
Emotional tools: zoom out the chart, switch from a one-day view to a 10-year view. Pre-commitment rules help. Write down what you'll do if the market drops 20%. Continue monthly investments, rebalance at a set interval, and don't sell out of fear. Also limit how often you check your accounts. Daily checking inflates pain due to loss aversion.
Anchor to your goals, not headlines. You're not investing for October next year. You're investing for decades. And remember why we did step 1. Emergency fund and fixed debts make staying calm possible. Automation helps because you keep buying when prices are lower. Dips are actually opportunities if you can look past the headlines.
Let's bring it all together with a checklist. Quick run through, hey?
Sure. 1. Get your financial house in order. Tackle high-interest debt. Build a 3 to 6 month emergency fund and stabilize income and tracking. 2. Define goals and time horizons. Cash for 0 to 5 years, increasing stock exposure after that. 3. Pick the right accounts. Take employer match, use IRAs or local equivalents, and use tax-advantaged accounts like ISAs or TFSAs when they exist. 4. Start small and be consistent. Even $50 to $100 a month matters. Harness compounding. 5. Diversify using index funds. Low cost, broad exposure, keep individual stock bets small. 6. Automate and simplify. Auto transfers, recurring investments, minimal tinkering. 7. Stay calm when markets drop. Crashes are normal. Recovery has historically followed.
Final emotional note: you don't need to be rich to start. You become relatively wealthy by starting. You don't need a finance degree. You need a simple plan you can actually follow. Mistakes will happen, but if you stay in the game, keep learning, and keep your horizon long, those mistakes are footnotes.
Okay, quick practical action items for listeners in the next week. 1. Check whether you're missing employer match. If yes, set contributions to capture it. 2. If you don't have a $400 buffer, open a high-yield savings account and start a recurring transfer. Even $25 a week helps. 3. Pick one broad index fund or ETF and set a small recurring buy, $50 or $100. It's about the system, not the size.
And one thing to avoid this week: don't open 5 speculative trading accounts or chase the latest meme stock. Keep it simple, especially early on. Also, bookmark this episode or write down your pre-commitment rules for a market drop.
Before we go, JJ, what's one final reassurance you'd give someone who's anxious and late to start?
I'd say your greatest asset is time, and it's not too late. People often think I missed the boat, but consistent steps over decades beat perfect timing. Start small, automate, and let compounding do the heavy lifting. You'll thank yourself in 10, 20 years. Okay?
That's the heart of it. If you liked this roadmap, share it with a friend who's been nervous about investing. Next episode, we'll take a deeper look at building a practical starter portfolio using specific low-cost funds and rebalancing basics. Thanks for listening. I'm Heidi.
And I'm JJ. Remember, this is education, not personal advice. If you enjoyed the episode, subscribe, leave a review, and most importantly, take one small step this week. See you next time.